and mining, oil and gas, cement at JPMorgan India, and he's joining us from the sidelines of the JPMorgan India Investors Summit. Pinakin, great to have you on the channel. Great to have you on the program. Thanks very much for your time. Prashant this side. Let's just start with exactly that, cement. The big announcement from Ambuja. What do you think it means for the sector? Are we going to see a lot of organic capacity in your expectations, or will we see them buying up a lot of existing capacities from companies already listed? What's your sense, and what does it mean for the sector and investors?
Sure. Good morning, Prashant. So, clearly cement is right now in the news flow. We would not talk about individual specific companies, but what the markets seem to be pricing in at this point of time is a wave of consolidation. We have seen cement stocks across the board move higher. Every cement stock is trading at near lifetime high EV/EBITDA multiples or an EV per ton multiple. So it's asset-based or earnings-based. Historically, what we would point out is that most of the times that cement assets have changed hands, they have taken place when there has been distress in the industry, there has been leverage in the companies, and the NCLT process accelerated that process. At this point of time, if you look at the listed universe, there is very little leverage across most cement companies. So there is no stress. Having said this, we don't know who could be the potential sellers. What we would point out is that unlike other industries, cement does not demand a lot of capex on a run rate basis. You set up a plant and then you have an annuity cash flows. So one also needs to keep that into account, that if you do not have leverage on your balance sheet and you have an annuity cash flows, are they enough willing sellers to go around even if there are buyers at a certain price?
Okay, Pinakin, good morning. So just to carry forward that point, because we are having this conversation with the Shree Cement MD as well. He said, look, we are in the market, but the problem is that almost everything has gone up so much. So and the market's bidding every cement stock as if it's going to be bought over tomorrow, maybe by Adani, right? So is there a bit of a bubble being formed here in the cement space?
I wouldn't answer that. I wouldn't be able to answer that question whether a bubble is formed or not. But if you go back, right, just 2 months or so, the fundamentals on the margin for cement stocks were improving. You had petcoke prices which had fallen 30%. You had the seasonal cement price hikes which were supposed to start from the festival season. The stocks had underperformed, and the stocks started rallying across the board. But what has happened in the last 4 to 6 weeks is purely expectations of an event. Our problem is that we look at fundamentals, we don't look at momentum. And when we look at fundamentals and we look at the capacities that are getting ready for commissioning over the next 12 months, companies who are putting money into organic capacity expansion, that's a very, very big number. So in that context, the incremental supply demand is not going to be as positive as it was in the last 18 to 24 months. So at some point of time, these expectations that the markets have need to crystallize into action for stock prices to be supported. Otherwise, there would be disappointment.
Sure. My only question, Pinakin, is that what happens to the erstwhile players, right, when such a big entrant comes into the market and pumps in so much money? I mean, Adani is looking to double its cement making capacity in the next 5 years. So what happens to names like Ultratech Cement and say something like a Shree Cement? What do you do with those stocks if you own them?
Sure. So again, I would refrain from making company-specific comments, but essentially what happens is that in an industry where you have had a structure which has been prevalent for the better part of a decade, where select companies have gained capacity share, and now you have a new entrant who is effectively going to gain capacity share at a faster rate. That puts pressure on the incumbents. Do the incumbents match the organic capacity expansion plan? Do the incumbents go for inorganic expansion plan? So essentially, everybody would have to make decisions in terms of what do they want to do with market share, what do they want to do with capacity share. And my sense is this problem gets aggravated even further next year when a lot of brownfield capacities which started work in the last 18 to 24 months starts getting commissioned and you have incremental supply hitting the market.
Pinakin, you track the metals, mining, and of course the oil and gas space as well. So let's just shift our focus towards that. Let's address metals and mining. What's your view there, both steel and non-ferrous? What do you like and why?
Sure. So, sure, we are basically exiting the seasonal downturn that we see globally in the June, July, August period. Destocking is broadly behind us. We have seen the first steel price hikes, being announced in Europe, even in the US. Half of it is going through. The big elephant in the room is obviously as to how does China's peak construction season demand play out. It starts sometime from September, October. So far, it seems muted. On the margin, our view is that given the destocking that we have seen, steel prices, at least globally, should move higher. Not very high, but at least there should be some rebound. In non-ferrous, obviously, aluminum is going to be in focus because you have low inventories, you have hydroelectricity issues in Yunnan, there have been production cuts in aluminum, there are production cuts in Europe. So if demand stays robust and energy costs stay where they are, then non-ferrous aluminum is something to look out for, because on the margin, supply in aluminum will only reduce from here given the energy shortages that we are seeing in Europe and the hydropower situation in China.
Okay, but in that context, wouldn't Alcoa's recent warning have an impact, or do you think, of course you won't comment on individual names, but Indian aluminium players perhaps have different dynamics?
Sure. So, if what is interesting is that quite a few U.S. downstream aluminum companies have basically looked at cutting guidance. When you look at their commentary, they have highlighted cost issues, they have highlighted operational issues, but so far nobody has really spoken about demand. And as long as demand on the ground is not deteriorating, I think the focus will be on supply. So what you have in aluminum in particular is supply and demand outlook. Both are changing very fast, but the supply outlook is more immediate given the two production centers, one in Europe and one in China. And you also have seasonal restocking in demand. For aluminum, the auto production global outlook is very important, and that on the margin has improved, and that should support aluminum demand. And if aluminum demand rebounds and you still have lingering supply issues, then the only way out is for prices to go higher.
Okay. You also have coverage in the oil and gas space. You track names like ONGC, Reliance very closely. Not taking individual names, but where do your preferences lie?
So at this point of time, our global house view is that we do not know how exactly the European energy situation evolves, but essentially the entire complex of coal, gas and diesel should remain supported. So we still prefer pure refiners who are basically able to export diesel. We prefer the upstream producers in gas and coal. So we would rather be upstream or in the refiners, rather be in downstream in the energy space. Yes, I mean, we would watch out for the Chinese, fuel product export quotas. There's a lot of chatter about them increasing the quota. So far, nothing has happened. And we are still yet to hit peak demand in Europe. So anybody who exports refining products, I still think on the margin is well placed.
Pinakin, thanks a lot for joining us. Have a good summit, and we'll touch base with you later. Thanks a lot for your time today.